Good morning, everyone. I'm Susan Seville, and I'm the Director of Sales for Federal Home Loan Bank Topeka. Welcome to the 2020 virtual regional meeting. We are so glad that so many of you were able to join us today. And today, our audience is made up of members from all four of our states: Colorado, Kansas, Oklahoma, and Nebraska, including the conference participants at the Nebraska Independent Community Bankers Association conference in Lincoln today. So hello to everyone, and thanks for being with us this morning. Just like the rest of this year, this meeting is a little different. We wish that we were meeting with you in your state and getting to play golf with you today, but we're so excited to have you here and see you all the same, and we have a great program lined up for today. Just one housekeeping item that I'd like to go over as we start. The speakers today will be taking questions after their speeches as time allows. And in order to ask a question, feel free at any time while they're talking to enter it into the Q&A function in WebEx.
There's a volume button too.
Yeah.
And that Q&A function is located on the right-hand side of your screen. If you don't find it there, it should be located at the bottom of your screen next to the chat function. And when you click into that chat function, there might be a question entered already. Just type over it and put your question in and submit it. And as time allows, we will answer those questions. Also, we are drawing for 2 nice prizes at the end of the meeting. And so make sure that you stay logged on till the end so that you're eligible to win. With all that, I will turn this over to Sonia Betzworth, who is Federal Home Loan Bank's Chief Administrative Officer. Sonia?
Okay, can you guys see me? There I am. So thank you, Susan, and good morning to all of you. As Susan indicated, my name is Sonia Betzworth, and I'm the Federal Home Loan Bank's Chief Administrative Officer. I have the privilege today to introduce our first speaker, an individual that I have had the opportunity to know for almost 4 decades. You see, our first speaker began her career at the Federal Reserve back in 1982, 1 year before I started my career at the Federal Home Loan Bank. Even though our careers have been with different organizations, we have had numerous opportunities to work together on credit and banking issues impacting both of our memberships. Our first speaker is Esther George, the President and CEO of the Federal Reserve Bank of Kansas City. She leads a workforce of close to 2,000 employees in Kansas City and its branch offices in Omaha, Denver, and Oklahoma City. The Kansas City Fed is responsible for conducting monetary policy, providing financial services to depository institutions and the U.S. Treasury, and supervising nearly 1,000 banking organizations within the 10th Federal Reserve District, a 7-state region that includes Western Missouri, Kansas, Nebraska, Oklahoma, Colorado, Wyoming, and Northern New Mexico. As a region's representative on the Federal Open Market Committee in Washington, President George participates in monetary policy deliberations and provides a perspective based on 3 decades of experience as a banking supervisor. Her policy views are informed by regular contacts with the region's business leaders, workers, financial institutions, and community leaders. President George also leads the development of the FedNow service, which will provide financial institutions with the ability to settle payments in real time, 24 hours a day, 7 days a week. In addition, she hosts the annual Jackson Hole Economic Policy Symposium in Wyoming, which brings together international central bankers, researchers, and policymakers to discuss issues affecting the global economy. Please join me in welcoming Esther George.
Thank you, Sonia. So good to see you. I don't know how long it's been, but
Thank you very much for that introduction. And let me just say how much I appreciate the opportunity to participate in your meetings today. First of all, as Sonia noted, the Federal Home Loan Bank of Topeka overlaps with our region in terms of its own responsibilities, and of course plays such an important role in the financial system here and nationally. And I am so pleased that we have for many years had a very strong working relationship where our responsibilities intersect. So it's great to see you, Sonia, and I just want to thank your team there for the work that they do with us. And I also want to thank the Nebraska Independent Community Bankers. Again, relative to the Kansas City Fed's role, we benefit enormously from our engagement with the banking system in our region, largely a group of regional and community banks. And I want to recognize Greg Hull from the Wahoo State Bank, who currently serves on our board of directors. That board provides valuable insights to me, to our management team here, on how the economy's doing and issues that affect banking. So again, my pleasure to be here. I thought what I'd do today is offer you my sense of how the economy's doing and what a year 2020 has been on certainly the healthcare front, the economic front. Many issues have challenged the public institutions as they carry out their work. So I'll offer you a perspective on how I see things unfolding, how the Federal Reserve has positioned its monetary policy, and then I'll close just with some high-level observations about the banking system and its functioning today and some of the challenges that I think it's going to face in the years to come. I think in Sonia's introduction, her comments about the backdrop for how I think about national policy really does come from the region that I serve. Those 7 states, our connections in those 7 states are so critical. So when you think about the diversity in that region, obviously wide open spaces, many rural places in that region, but also a number of metropolitan areas. And so you see a range of economic drivers from agriculture to aerospace in that region. We have auto manufacturing. Energy is dominant in this region. Transportation to the ski slopes of Colorado and the tourism that comes with that. And so making those connections in our region really are essential to me in terms of how I understand the economy is unfolding and what the drivers are of that. So you will see us collecting regional data through surveys that range from hearing from our manufacturers, those that are in ag finance and other parts of the economy, to actual engagements one-on-one. So making sure that we're connecting in with consumer groups, with business leaders, with those in the community that serve a variety of needs. And hearing from them really tells us not only how people are experiencing the economy today, but you can hear in their stories, in their assessments of the economy, how they are looking ahead. Where will they spend? Where will they hire? And I think particularly important today is how confident are they about their economy, their local area as we go forward. So all of that will influence what you'll hear from me this morning about how I see the national economy. We, of course, as you know, really fell off a cliff in the second quarter when the economy essentially shut down because of a public health issue. And so coming into the third quarter, the recovery that we've seen has really been not only more robust, but frankly more rapid than I thought it would be. I think it was more robust than even financial markets and many of our business contacts thought it might be. When you look at retail sales, they bounced back really to pre-pandemic levels. The labor market has also made up a lot of ground. So some half of the 22 million people that lost jobs in March and April have seen a comeback to many of those jobs. And there are a couple of reasons I think that we saw a particularly strong bounce back. One, of course, is the fact that there's been an evolution in the way that public health authorities are responding to the virus. And by that, I mean, initially, you saw these broad-based lockdowns, and that has shifted to more targeted restrictions. So certainly everything in the economy is not opened up again fully, but you are seeing increased willingness and ability of the public to engage in certain activities. The second thing, though, that I think we can't lose sight of is really the massive and very quick government support that came out, and that's played an essential role in this recovery. One measure that I think is really noteworthy is considering how many jobs were lost. It wasn't surprising that we saw wages and salaries fall to a record low in that second quarter. But when you look at personal income, which includes those transfer payments that came from the government, they grew at the fastest pace in history and reached a new record high. So clearly, the recovery that we've seen has importantly come from not only better public health measures that allowed people to get out, but also the response from Congress. The Federal Reserve itself has played an important role in buffering the effects of the pandemic with its own set of quick and I would argue very aggressive response. So going back to early March when the Federal Reserve cut its benchmark interest rate to near zero, also began buying significant quantities of Treasury securities and agency mortgage-backed securities at about the pace of 120 billion a month still. And a number of new credit facilities were established to promote the flow of credit to the economy. And again, unprecedented in terms of the scope. So some of the tools that had been used during the last crisis were pulled off the shelf. The new ones were introduced, things like municipal finance credit facilities and a corporate bond facility, even one that we call Main Street. So the good news is that the recovery so far has been more pronounced than many expected. But I think you would agree with me, if you were to pull back the covers of some of those aggregate numbers, you would see that unfortunately the gains have not been evenly shared across the economy. And that, of course, is because of the unequal toll that the pandemic has taken across different sectors of the economy. Things like restaurants and other services that people would normally consume outside the home have been able to only partially recover during the third quarter. And some, if you think about movie theaters or concert venues, those still are virtually shut down. On the other hand, we see some sectors which I heard some people described as booming, and I think that's probably true. Things that we consume in terms of goods have more than recovered. So there is a home improvement frenzy going on, if you will. People have been buying more electronics, including personal computers, probably in part to help kids learn at home, to help people work from home. Even things like bicycles have shown really considerable strength during this period. And I think there's no question, if you look at low interest rates, those have undoubtedly boosted the purchase of some of those goods, and I think certainly have underpinned the strength that we see in the housing market. So the unevenness in that recovery, of course, also shows up when you look at the labor market and try to make some judgments about how that job market is doing. We peaked at around 15% unemployment in April. That, of course, has come back now to just under 7% by October. And so I think all signs are we are moving in the right direction, even if we still have a ways to go. And by that, I mean still some 10 million people are unemployed, and others are dropping out of the workforce right now. That sharp drop-off that we saw in jobs still remains concentrated in service-providing industries, which I think if you looked at past recessions, you would have seen that usually is a pretty stable part of the economy. And it's usually manufacturing and the goods sector that really take a hit. So it's different this time in terms of the sectors it's affecting. If you're in retail, if you're in leisure and hospitality industries, you've been hit pretty hard. And those have also noted some of the largest gains more recently. The other aspect of unevenness that I see in that labor market that I think we will have to watch in terms of how robustly it comes back is these job losses have hit particularly hard on women and people of color. So women and minorities are represented disproportionately in those service providing industries, and they of course are bearing the brunt of some of those job losses right now. So the pace of recovery encouraging, that is true, and my outlook is the economy will continue to recover. But when you think about what lies ahead, there are really two risks to my outlook, and they probably won't surprise you. One of those is the virus itself. In fact, my colleagues and I that sit on the Federal Open Market Committee have noted in our statements, we talk about it at our meetings, and that is the path of our economy and this recovery is going to depend significantly on the course of the virus. And so today, when we see a resurgence across nearly every state in the virus, we are beginning to hear about renewed imposition of control measures and restrictions. Those are the kinds of things that give me some pause to see how will that affect the recovery going forward. It could throw it off track in some sense. We've already seen this dynamic playing out in Europe, where cases have spiked again in many countries after falling over the summer. So I think the truth is the economy is going to struggle to really fully recover until the virus no longer interferes with the public's day-to-day decision-making or their ability to resume fully the activities that they had coming into this. And that, of course, I think is going to depend on some level of confidence that the virus can be managed. Hopeful signs that a vaccine may be coming. There may be other things that will allow the public to begin to resume those activities. The second risk, in addition to the virus, though, is to say what I said earlier, and that is part of the strength of this recovery has come from the supports from fiscal policy. So Congress is able to make decisions that can target money to sectors of the economy that would benefit most. That's really different than what the Federal Reserve does. When we begin to lower interest rates, that has broad-based effects. But I think when we look at the sectors of the economy that have been sustained during this period, whether that's individuals or small businesses, that has been important. And so today, as we see some of that funding begin to fade, and there are questions about whether there will be additional monies, that is a risk just to watch and say, what will that mean as that funding dissipates, and will there be additional funding, again, to bridge the recovery? Right now, it looks like those that are most at risk are the groups I talked about. They are those workers that are in segments of the economy that are not able to come back until the virus subsides in some way. They are small businesses, which of course are very important in my region. And I think also important here are state and local governments. They have had to boost spending on public health measures at a time when they're experiencing significantly lower tax collection. So when you think about deteriorating budget positions for state and local governments, it seems likely that they too may need some support in going forward. So the recovery has been encouragingly fast, and my outlook is that the economy will continue to grow. But I think it's fair to say there are important risks to that outlook. And I guess my bottom line would be we are not out of the woods yet as it relates to the economy. Let me turn then to how my colleagues and I have been talking about monetary policy and its settings. As you know, we met last week, and at that meeting, the FOMC decided that it would keep its current policy settings unchanged. So by that, really, I think about it in three parts. One is the short-term interest rate remaining near zero, continued growing of the Federal Reserve's balance sheet by about $120 billion a month. We're already about at that $7 trillion mark with our balance sheet. And the third thing is maintaining these credit facilities that have been provided to a wide range of borrowers, including small businesses. That direction, that guidance to really continue to monitor the economy, keep that policy at very accommodative levels, I think is important as we watch the recovery progress and really try to get signs of when it becomes more self-sustaining and continue to reach its potential. So you are unlikely to see the Federal Reserve talking about normalizing or beginning to pull back on its accommodative policy until a couple of things. One is, as we are tasked with by Congress, watching carefully what's happening with employment and with price stability or inflation. And as we watch those two things, those will really be the drivers, I think, for how the Federal Reserve thinks about any changes to its policy. There's always a question about how long. How long will rates stay low? How long will we stay at this highly accommodative level? And I think one of the things you have to look at is the outlook for inflation, for example. It's not clear yet, given all the disruptions we've seen in supply chains, while at the same time seeing other sectors that are depressed, where inflation is really going to settle out in terms of its path forward. So we know, for example, that there are a few sectors that have been hard hit, and the collapse in demand for them is going to put downward pressure on inflation. In other sectors, though, so think about these home improvement projects, and if you've tried to get a contractor or have some construction work done, you know their strong demand may actually be boosting prices. So looking across the basket of things that are measured for inflation, I think it could take us a while really to judge, will inflation take off, or if the pandemic unleashes some deeper or more prolonged recession, of course, you could see the drag on inflation be more pronounced. So something that I think will be an important guide to how the Federal Reserve thinks about its interest rate policy going ahead. Let me close with a few thoughts on the banking system. Again, so important to how this economy has been able to function going through the pandemic. And I will focus my comments by and large on smaller institutions, particularly community banks, which are not only very prevalent in the region I serve, but I think often we forget how important they are to the macroeconomy and to the nation in terms of how they provide credit to small businesses, how they foster the vitality of many small communities around the country. And so what we've observed the past 8 months is really how critical these institutions are to deploying, whether it's the SBA's PPP program that came out fairly early, to their own actions with their portfolio of borrowers very quickly before any government programs came out. We're sitting down with people to understand how can we assist you. The deferral of payments and other things have been critical to, I think, the success that we've had so far in terms of an economy that's been able to recover. And that role, I think, will be one that will continue. I hear from bankers questions about what will credit look like as we go forward? How much longer can some of these borrowers hang on? All fair questions, I think, as we look ahead. And also, let me touch a little bit about the payment system, because again, community banks find themselves needing to deploy the same technologies that we see increasingly being deployed on platforms outside the banking system, as well as by some of the largest organizations. So let me hit on some of these issues as it relates to that set of banks in terms of what does it mean to have low interest rates for an extended period? What will it mean for the supervisory environment over the next few years? And what about their role in the payment system? Monetary policy, as I just said, is probably not only situated in a highly accommodated place, but if you look at the forecast from my colleagues around the FOMC table, you will see that it is anticipated rates will remain low for some time. And that, of course, has particular implications for banks whose business model is what I call a traditional lender with a core deposit base. Obviously, those low rates are benefiting right now your borrowers in terms of mortgage refi activity, auto purchases, any number of things. So it may have positive effects in terms of boosting loan demand. But of course, we hear very clearly, and I see it in the data, it also brings particular pressures to community banks on net interest margins. An extended period of low rates not only gives you issues around compression of those margins, but obviously challenges profitability and the ability to manage future credit losses. So the cost of that can be particularly felt on our banking sector right now. And that's why making sure that the accommodative policy reaches its aims is important. What you don't want to see is unnecessarily incenting institutions to reach for yield or taking on more risk to try to overcome that environment. In the area of bank credit losses and the supervisory framework, obviously the three banking agencies were very quick to work with the banking industry around relief on some traditional measures of capital and liquidity to allow banks to be able to engage with their customers. And I think that was the right decision. The question is, how much longer will that sort of forbearance remain in place? And so I watch that carefully, as I know you do too, because bankers are already beginning to look at their own portfolios to see which of these businesses are likely to survive this period, in what ways will they be altered, and where might you see future weaknesses in that portfolio. So that will be an area I think important, not only to work with banks from the regulatory side, but I think importantly, hearing from the bankers themselves who will understand most keenly where those risks lie in their own portfolios and how you see those losses unfolding in the months and years ahead. And then finally, let me just say a word or two about the landscape, which I think has been unfolding for some time around how consumers pay for things. Obviously, the public has gotten quite used to being able to transact purchases online and increasingly wanting to pay for things online as well. And that happens in a variety of ways today. But the ability for individuals to trade money, for businesses to transact, is still running on rails that involve a check system, an ACH system, that actually don't deliver those payments as instantly as people may think or want them to. So several years ago, the Federal Reserve began to seriously engage with the banking industry and others to say, how does the U.S. payment system need to be modernized? And I know all of you see many of these changes unfolding. And you've been loud and clear with the Federal Reserve about how important it is the Federal Reserve provide the kind of infrastructure that will allow the payment system to be broadly accessible, from the largest to smallest banks, to be able to have integrity or safety with that system, and to be transparent in how it is priced and delivered. And so last year, the Federal Reserve made a decision to build a new service, which has been called FedNow. And we are well underway in terms of constructing a real-time settlement for retail payments that individuals will be able to use through their banks, that businesses will be able to transact with. And I think combined with the current system that the largest banks have built should fill out for this country a very modern rail on which to transact payments and reflect, I think, the opportunity for more innovation to build off of that. So that's an important initiative that's underway. We are a couple of years from delivering that, but already beginning to work with the banking system on how they're getting ready. We've engaged with a pilot program because we know it will take some time to reorient systems, to get standards and all the rules in place that will allow the public to be able to use this new system. So an exciting time on the technology front, even if it is also challenging at the same time. So let me close before I take your questions again, and just note the economy is on track in terms of a recovery, but of course, how it unfolds over the next year is going to depend on how this public health issue gets addressed. It will depend on what kind of supports are available from fiscal authorities, monetary authorities, in terms of how robustly that recovery can continue. And of course, the Federal Reserve has noted its commitment to do what it can with the instruments of policy at its disposal to support that. And let me also say that the Federal Reserve, and particularly the Kansas City Fed, remains keenly focused on the role that our smallest institutions play in this country and the support of small businesses, the support of our communities. And we look forward to working with you, whether on the payments front, a supervisory front, as you meet those needs of your community. So with that, thank you again very much for the opportunity to speak at this year's conference. And I look forward to your questions.
Thank you, Esther. Appreciate it. We have a few questions that have been posed, so we will look at those here. I'm sorry, I'm reading and familiarizing myself with them. The first question has to do with digital currency. And the question is, what is the Fed and the banking system or the banking industry planning to curb the use of digital currencies used to facilitate criminal activity? And a secondary part to the question is, why are digital currencies exempt from BSA and AML regulations?
So there's a lot in that question. Let me just start by saying, first of all, that the rules around BSA and AML obviously get functioned through the banking system, and to the extent that things are running through the banks, I don't have to tell the bankers in the audience that, you know, the regulatory agencies do hold you to high standards around how payments are made and funds are moved through that. That law, however, does extend very broadly to that. And the question is, who enforces that? So ultimately, law enforcement, even beyond the banking agencies, are responsible for that. The question about digital currency, I think, is an interesting one because we are beginning to see a very quick evolution around everything that I think started out with a product called Bitcoin and various iterations of that, to now today hearing from central banks saying that they are studying this issue. in some countries around the world, actually creating prototypes for thinking about future deployment of a digital currency. And I think if you break it down to why would central banks be doing that, the question is, we are beginning to see more and more adoption of what I call private money versus currencies that have been used under government authorities to make sure that they are stable and reliable to the public. And so I think you're going to see a tension between the evolution of private money and governments thinking about what role they play. And for that reason, you will see even the Federal Reserve has launched an effort called Project Hamilton that is being led out of our Boston colleagues working with MIT, just to understand what are the dynamics of something like this. I'll close on that point, though, by saying one thing that will make this different country by country is when you think about the United States, we're a country whose currency is still in high demand. So people around the world want to hold dollars. It is still the trading currency around the world where many goods and trade settles. And so it doesn't seem likely that anytime soon you will see the Federal Reserve making a switch to that. In the meantime, I think it's appropriate to keep studying that and to watch what other countries are doing.
Our next question is, with the unprecedented amount of liquidity in the market, how should depository institution liquidity strategies be modified for the future, considering that at some point there will be a normalization?
It's a big challenge, I think, for our banking industry right now because a lot of money is there. We see a very high personal savings rate right now for households. And as you can imagine, in a zero interest rate environment and with some concern about what might be coming next, you will find people, I think, hanging on to their money as a way to buffer themselves against any future shock. We saw this after the great financial crisis, some tentativeness in terms of deploying money, and I suspect we'll see that again, people wanting to protect themselves, maybe even businesses wanting to hold more cash. The challenge, of course, for the banking system is to know which of those deposits might fly away at the point rates rise, which of those are likely to stay. And that will be a function of what opportunities exist in the economy and a function of confidence. So a particular challenge right now, and as I said earlier, being able to manage a compressed interest margin is going to continue to be a challenge for our banks. So I think it's something regulators obviously have their eye on. I think in terms of thinking about stability of the financial system, it's an important issue at the point we begin to see that money flow out, is where is it going and what will its implications be? Susan, you're muted. I can't hear your question, but.
Sorry about that.
That's all right.
So the next question has to do with inflation and what should the target be? Is 2% target too low?
Well, I don't think 2% target is too low because if you think about what it will do to the value of your money over the course of a number of years, the job of the Federal Reserve is to make sure that we have stable prices in the economy. And some time ago, the FOMC determined that price stability should be defined as 2% over the long run. And if you think about for some time, inflation has actually been pretty tame. Some people attribute that to the fact that central banks have targeted numbers like 2%, and that's caused the public to now expect that central banks will keep inflation low. And there are many other factors, structure of our economy and other things that affect the price of things. But I think what's important is 2% is a long run way of thinking about keeping prices stable so that businesses can make decisions for the long run, so that households don't have to worry about the value of their money. The question, though, implies, is it too low? And my answer to that would be no, I don't think so. I'm not sure that trying to pick the exact number, that's always a function, I think, of how the economy's doing. But the question probably comes because we've seen that inflation has run under that 2% target for quite some time. And that has caused the Federal Reserve over the past year to really look at how we talk about that 2% inflation target. So in September, the FOMC released a new framework, really a communication to the public that says, here's how we think about it. We are going to stick with that 2% target over the long run. But what we mean by that is it's not a ceiling. If the economy is growing in a way and jobs are being added, and we begin to see inflation get up to 2.2, 2.3%, that isn't going to cause us to put the brakes on and begin to raise rates. So that on average, 2% in the long run is what we're looking for. So that isn't a mathematical calculation, but I think to the question, it is to say 2% isn't a ceiling, but you can expect that the Federal Reserve will really be gauging how is the economy doing in the context before it makes decisions about changing interest rates.
Thank you. Let me pull up our next question. So the next question that was posed is, Dr. Michael Osterholm is advising Joe Biden to lock down for 4 to 6 weeks. What are the Federal Reserve's thoughts on another economic shutdown, and how much influence does the Federal Reserve have on this decision?
So it's, as you know, one of the risks that I noted as we see the virus resurging. And I think what's important here is public health authorities are front and center on this issue. I think it's important that medical professionals and others are telling us what has to happen to protect the public so that the economy can move forward. We saw the tremendous cost in March and April of these broad-based lockdowns. We also saw that as the medical profession began to say, here are other things that can be done short of these lockdowns, ways to manage the virus. So I will be watching that very carefully. I think, again, I'm not an epidemiologist, and we have to rely on those that can tell us what will contain the virus and allow us to function. But my hope is, both with the prospects of the vaccine, looking at other ways that we've been able to manage the virus, if we can do those things, it certainly will be better for the economy. It will be better for the people that work in that economy and are able to continue to support their families and support, I think, many of the activities that people really rely on. So I hope it doesn't come to that.
Me too. The next question that we have is around negative interest rates. So the person says, what are your thoughts on negative interest rates? Can you foresee that happening in the future if the pandemic continues to resurge and the economy takes a turn for the worse?
So negative interest rates have been deployed. We've had a chance to see other parts of the world use negative interest rates, and my own sense is that has not been an effective tool of monetary policy. And in fact, the Federal Reserve has said, as it's looked at a range of ways that it could respond to the economy, has said, we're taking negative interest rates off the table. We don't see their applicability in the US. we're not in a place where we've exhausted other things. And so I hope we don't come to a point where that's entertained again. And I think right now we don't have to worry about that. That means, though, that the Federal Reserve will be looking to things like how long it keeps rates low. It will be looking to things like its balance sheet. And so all of those, I think, should tell the public the Federal Reserve will keep doing what it can to do its part for the economy, but they're worth watching because every one of these tools carries some cost at some point. And so watching how they are deployed, what their cost and benefits are, will continue to be in focus for the Federal Reserve.
Okay, great. So the last question that we have so far is, you mentioned a more targeted approach to restrictions in response to the pandemic. How likely is another total shutdown? I think this is a similar question. And what impacts do you see on the economic recovery? So I think you may have already answered a lot of that, but.
Yeah, I think, again, obviously a total shutdown is catastrophic to our economy. And I don't think anybody wants that, particularly because it has not proven, I think, in some cases, to not cause a resurgence. It also is problematic, I think, though, as we listen to what things can be done. We have seen variation across the country and how well people adopt some of those practices too. So large gatherings, the advice we're getting about distancing and mask and all those, I think will really determine how well the economy can reopen. And ultimately, we want people to have confidence. People will make their own choices about whether they're going to go out and engage with the economy as they did before. And having some confidence that they have ways to protect themselves or have ways that they can do that safely, I think is going to be important. So that conversation looks like it will be ongoing, particularly at a time when we see the case counts rising.
Great. Okay, I think we have a couple more now that have come in. This one says, I recently saw that over 70% of stimulus money was used to pay down debt or saved. This should put consumers in a very good position to be able to spend money in the future months. And there is a lot of pent-up demand for travel, entertainment, and housing. Do we need anything more than a small stimulus package targeted toward businesses that are affected most by COVID?
Yeah, it's a great question right now. So I'm going to answer that in terms of what else is needed and what might consumers do with the savings in terms of pent-up demand. Let me start with how much additional is needed. I think, obviously, this is a question that Congress has to answer. And the reason I say that is not just because it's not the Federal Reserve's job. We have a very specific job around making sure financing conditions are very easy. But Congress is able to really target funding in a way that the Federal Reserve is not allowed to and shouldn't, in my view. And so deciding how much and where is really a job that we've handed to our representatives. And so they, I think, will have to be thinking about what role they play as we go forward. The question about how people are saving right now is one that I've had my own team looking at to say, should I expect with people's savings levels being high, that will just be waiting to go out and boost demand? In other words, will we need any other kinds of supports? Will that provide its own demand? And certainly there will be some of that. I think what you have to be keep an eye on, though, are a couple things. One is what I call the fear factor. We know that people will hang on to some of that money for a while because they may be concerned. Could I lose my job? Am I going to be at risk here in a way that I should create some kind of a safety buffer for myself? So that will be a dynamic we will have to watch, how much of those savings people will hold on to and for how long. The second thing is where the pent-up demand will come from. So as I noted earlier, where we see a lot of activity is actually in consumption of goods. So people are going out and buying things while they are at home or limited in travel or other things. The question is, when they're able to resume services, how many more trips will they take? If you missed one trip, will you take 3 next year to make up for that? You've heard the story of, if I haven't gotten a haircut in a while, I'm not likely to get more of those in any one setting. So I think there is a real question of how many of those services will make up for what's been lost or will extend the time in which they buy it. So no question, as I said, the job loss, the wage drop we've seen has benefited enormously by giving people that safety net, that cushion. If you're someone whose income is largely consumed by your rent and your food, you're probably not going to have as much of a buffer, or you'll be more concerned about that. Those at the higher end of the wage scale or income probably don't have the propensity to consume all of that anyway. And so that is an area I think we'll watch carefully. So watching what other supports come from fiscal authorities as they judge the economy, and then watching how households ultimately deploy what right now looks like a high level of savings. How much of that can they put out in the economy in the months ahead?
A couple more questions have come in. What are your thoughts about loss exposure on commercial real estate loans over the next 24 to 36 months?
Yeah. So my thought is this is always an asset class that gets hit first in any kind of stress situation. And we know many of our banks have a portfolio that includes that asset class. So obviously there have been regulatory actions in the past to try to gate that, to hold more capital against it and other things. But I think it could be the first asset class that we began to see some of the weaknesses. Obviously, we've seen low delinquency rates to this point, but I think as our bankers note, that's been because of some of these efforts to forbear, to defer payments and other things. So I think it's right to watch that. And that's why I say, obviously regulators will be watching, but I think the bankers are the ones I'll be relying on most to say, you tell me which of those customers, because as you know, commercial real estate is a broad category, particularly when you get into a community bank portfolio, and understanding what is behind that and how that property might fare. Obviously, retail properties going to be under pressure nationally. We see that already. We hear businesses talking about needing a smaller footprint because they think more of their employees will work from home. So that market, I think, is going to go through a period of adjustment over the next few years. And it will be an asset class, I think, that we'll have to keep an eye on in terms of what loss exposures will come out of that.
Great. Believe we have one more question here that's come in. With the national deficit being so great, additional debt will have to be issued. Will the Fed continue to grow their balance sheet by purchasing this debt at the same rate they have in the past, at a greater rate, or will the Fed slow down in their purchasing?
So it's a very important question, and I think it's one that's been on people's minds for a long time. Let me set the Fed aside. I often get questions from the public about the level of federal debt and should we be concerned about that. And so before we ever heard about coronavirus, I think the questions about how much debt can a country like the US carry before we run into problems of crowding out private sector investment, getting higher interest rates, is very much an open question. And the reason I say that is we can look around the world and see countries that get over indebted, and we see that they don't fare very well. The difference for the US is we are the world's largest economy. Again, we represent the world's reserve currency, and it gives us the kind of capacity to carry a debt load. And it's why I tell people during a time like this, during an emergency where the public's lives really depend on it, this is not the time to try to correct for what have been years and years of that debt growing, the demands coming from a retiring and aging population, our healthcare costs associated with that. But there will be a day where that will be appropriate to do. And we always have to be thinking about the long run and what our actions today mean for that. In terms of what it means for what the Federal Reserve is doing, again, I think it's important to remember right now, these really are massive amounts. It is mind-boggling, I think, for many of us to look and see the Fed's balance sheet in this short of a period of time going from under 4 trillion to now 7 trillion and growing. And the aim of those purchases, of course, is to make sure that our financial markets are stable. They're doing that now, but these purchases are keeping low rates at the longer end of the yield curve. This is what's helping the mortgage market right now. So there will come a time when the Federal Reserve will have to address the question of how is the economy doing relative to what we've been asked to do? And what role are we playing in terms of a growing footprint in the financial market with these purchases? I look forward to when that day comes because it's likely to mean the economy is doing better and we can begin to have that conversation. But it's a great question and one that I think we have to keep talking about as we judge both the economy's progress and how fiscal authorities are making spending decisions.
Thank you so much, Esther. I think that was the last question that the audience has posed for you. We really appreciate you sharing such great information for us today and being so open about answering everyone's questions as they were posed. Thank you very much for being with us.
Thank you for having me. And Sonia and Mark, I hope I get a chance to see you all in the not too distant future. So thank you for moderating, Susan.
Thank you.
All right. Bye-bye.
So we will move on to the next section of our program here. It was great to hear from Esther. This section, we're going to allow your account manager here, that's normally the MC of these events, and they do it so well when they're doing them in their own states and own meeting. We'd like to give them a chance to talk with you for a couple minutes, introduce themselves in case any of you haven't seen them face to face for a while and forgot what they looked like, and tell you what they're out hearing while they're having conversations with our members that are all happening virtually right now, basically. So Mark Woida, would you like to get us started? Oh, Mark, you're on mute.
Okay, can you hear me now? Yes, okay. Good morning, good COVID morning to you all. My name is Mark Woida, and it's been my privilege to be an account manager with the Federal Home Loan Bank for the past 22 years. I'm a native Nebraskan, am Omaha-based, and have served the eastern half of Nebraska for the past 22 years. And for the past 6 years, I've also served our members in Northeast Kansas. The reason I refer to my time with the Home Loan Bank as a privilege is twofold. First, I'm a true believer that community banks and credit unions are the vital economic engines for our country. And secondly, it's because I get to work with great people like you, Midwestern, down-to-earth people who succeed by serving your customers in your community. The Federal Home Loan Bank's core business is lending money to our member financial institutions. We primarily meet two of our members' needs, that being for liquidity and for hedging interest rate risk. And liquidity seems to be in abundance in these COVID PPP days. And for many of our institutions, lending out that excess cash is one of the keys to future profitability. And during this time of record low interest rates, I presume that many of your customers would love to lock in long-term fixed rate loans. But as a financial institution, you're wary of the interest rate risk and would prefer to stay short. So what's a financial institution to do? One possible solution is to hedge that interest rate risk with a long-term fixed rate, that long-term fixed rate loan with a similarly structured long-term fixed rate advance from the Federal Home Loan Bank, thus having similar duration for both your asset and your liability, mitigating your interest rate risk. To help you analyze such transactions, we have developed a blended funding tool. This analysis is available to you, our members, at no cost and no obligation. Your account manager or our lending desk can work with you to input the long-term fixed rate loan you are considering making, then play multiple what ifs with different advanced structures in order to find the optimum advanced structure that would best meet your financial objectives. You could choose to 100% match an advance to your loan and thereby eliminating all interest rate risk, or you could blend in some of your deposits in funding this loan along with a long-term fixed rate advance, thereby eliminating most of your interest rate risk, but also enhancing your spread. Our tool uses current advance rates along with the loan and advance structures we input to calculate the spread that you would make on each strategy. If you would like to see this analysis, then contact your account manager or the lending desk, and we can work with you to analyze such strategies. Thanks, and I look forward to one day seeing you again face-to-face in person.
Good morning. My name is Jeff Steiner. Thanks, Mark, for that great update. I am your Kansas account manager, or as Mark said, the majority of the state of Kansas. I handle all, but Mark handles Northeast Kansas, and you'll hear from Rusty Davis here shortly. Then handles a little bit of our Western slope. So it's great to be here with you this morning. I hope to meet most of you Kansas members that I haven't met. I've talked to most of you over the years, as I've spent 10 years with the bank. I spent my first 6 years on the lending desk and managing the lending desk, and then an additional 3 years calling on our Oklahoma members. So good to see all you folks on today. Spent about the last year or so with our Kansas members. So the question was, what are we hearing from our members right now? And as Mark alluded to, tons of liquidity, tons of cash right now, and no place to put it, no place to invest. Well, recently we partnered with one of our members, Union State Bank in Clay Center, Kansas, specifically Sandy Fox, our longtime CFO, who worked with us on a staying invested strategy. Now, obviously, as we've talked, staying invested is really tough right now. There's not many options, not great yields. But I think the one thing that the article drew out was there's a need to have that collateral in place right now and work with us to get those loans pledged, put those loans to work in the time that excess capacity or excess cash and liquidity does roll off the books. So we recently had some collateral webinars. Give us a call, see those, they'll be online. But the other thing that the article does touch on is specifically, as Mark talked about, how they were, because they put these loans to work and have this excess capacity with us, they were able to go in and lock in some long-term fixed rate assets to put their excess capital to work in these times of excess liquidity. So again, great article. Take a look. It's on our public site, FHLBTopeka.com, on our financial intelligence page. So I hope the next time I see all you folks, it will be in person. But in the meantime, please stay safe and well.
Yeah, good morning and happy Friday, everyone. Mark, Jeff, thank you for those updates. My name is Trent Meyer, and I'm the new account manager for the state of Oklahoma. Although I just started as the account manager down here in January, I've actually been with the Federal Home Loan Bank for a little over 6 years now. Much of that time was spent on the lending desk, actually working with Jeff. So I've gotten the opportunity to talk to most of you, but I'm excited to get back out on the road and visit with everyone in person and officially introduce myself. There are a couple of topics that I want to discuss today that I've seen members using throughout our district, but especially in the state of Oklahoma. And the first one of those is advanced restructures. Now, Esther certainly talked about the prevalence of margin compression right now, and we understand the importance of you reducing your borrowing cost, and advanced restructures is one thing that will allow you to do that. Much like a lot of your customers are doing with refinancing their loans down to lower rates during this low rate environment that we're in, you can do the same with your advances by using the restructure tool. So certainly if that's something that you've got, if you've got some high rate advances on your books and you'd like to restructure those down to lower rates, please reach out to your account manager or the lending desk. We'd be happy to run those analysis for you and see what kind of money you could save. And the second strategy that I'm seeing employed frequently now is our forward settling advance. Of course, Esther talked about the unlikelihood of us seeing a negative interest rate environment. Well, if that's the case, then we are at all-time low rates right now. And so it's a good time to start preparing for the future. And the forward settling advance allows you to lock in rates today in this low interest rate environment and take advantage of those down the road when we potentially see increases. Of course, being at the low right now, we typically see a reversion to the mean. And I think that's what some of our members are expecting, and that's why they're locking in these forward settling advance rates today. So certainly something else to consider as you manage your balance sheet in this interesting environment that we're in. But once again, thank you all for coming out. I'm happy to be here with you. I can't wait to come out and actually meet everybody, and enjoy the rest of your Friday, and I'll turn it over to Rusty.
Thank you, Trent. Well, good morning, everyone. My name is Rusty Davis, and I am the Regional Account Manager for Colorado and parts of Western Nebraska and Western Kansas. I joined the Home Loan Bank back in July of this year. I've worked in banking for over 30 years and have spent most of my career in correspondent banking, working with financial institutions across the country. One common challenge I'm hearing from a lot of financial institutions everywhere is this large influx of public deposits. Historically, financial institutions have collateralized these by pledging securities in your investment portfolio. By using the Federal Home Loan Bank's letter of credit product to collateralize public funds, you can improve liquidity, invest in higher yielding assets, and streamline the collateralization process. Additionally, our letters of credit can now be executed online on our members' website. So please reach out to the Rams with any questions you may have. And like everyone else, I hope to meet you guys soon. Thank you. Chris, over to you.
Thank you, Rusty, and thank you, everybody else. Great updates this morning, and thank you all for joining us today. We know it's not the way we wanted to do it, but it's certainly making the best of a bad situation. My name is Chris Endicott, as you can probably see from my label, and I'm the MPF account manager for the Federal Home Loan Bank. I've been with the bank for 15 years, all of it within the MPF program. Obviously, this year we've in that 15 years, I've seen quite a bit of changes within the program, some good, some bad. Obviously, this year we've seen quite a few changes with the MPF program, and those of you that utilize it are fully aware. We've seen pricing challenges. We've seen changes in our stock requirements. We've seen a dramatic increase in business from refinances across the district and across the country, and of course, all of this during the middle of a global pandemic. Clearly, these are strange and unique times. What we're seeing from our members, though, is an interest in our lesser-known MPF Extra product. This is a product that allows our members to utilize a Fannie Mae pass-through option to provide competitive rates, competitive pricing, while still providing them many of the same flexibilities and opportunities that the MPF traditional product has provided. As with probably many of you, and people across the world, I'm looking forward to moving into 2021 and turning the page on this very strange year and challenging year. And I'm looking forward to getting back to the business of helping our members to continue to grow their business. So again, thank you guys very much for being here today. We appreciate your membership, and we appreciate your business. Susan?
Thank you guys for sharing that update on what we're seeing and hearing from members as we talk with them. Next, we'll be hearing an update from our president, Mark Yardley. Mark?
Thank you, Susan. Thanks to everyone who's here with us today for our virtual regional meetings. I wish we could be in person, but not happening right now, but hopefully next year we'll be able to be face-to-face and having in-person meetings, and for some of you playing golf. As Susan said, I'm Mark Yardley, President and CEO of the Federal Home Loan Bank at Topeka. Jesse will be putting up my slides here in just a minute. I've been at the bank for 36 years, the last almost 4 years as president and CEO. So I've been at the bank for a little bit of time, not quite as long as Sonia, as if you heard Sonia give Esther's introduction, but I've been there for quite a while. I'm going to spend the next 15 minutes or so giving an update on the status of the Federal Home Loan Bank and how we're doing. Then open up for questions. If you have questions, put them in the Q&A box, and Susan will be handling those at the end. Next slide, please. Uncertain times, 2020, COVID-19, as Esther said, is the story of the year. Along with the economic devastation and the rampant unemployment we've seen as a result of the COVID. As Esther said, it's a big bang. It happened all at once. So unlike past recessions, it's been, it hit March, April, and we saw the massive shutdowns. We saw the unemployment just skyrocket. And I did appreciate her positive outlook and positive comments on the pandemic and the recovery thus far and the risks of that recovery going forward. Coupled with the elections, the historic wildfires and hurricanes that we've seen, along with the social unrest that we've seen, civil unrest across the nation. 2020 has been an eventful year, as Chris Endicott said, looking forward to 2021. And we talk about elections. We know that the 2020 elections aren't over. The U.S. Senate's not yet decided, and we have 2 runoff elections in Georgia to determine the majority in the Senate. So that occurs on January 5th. I don't know about you, but I'm glad to see all the negative commercials on the airways that are no longer being shown around here. And I can't imagine how bad it's going to be with everybody focused on Georgia right now and all the commercials you're going to see down there. Ryan Gilliland will fill us in a little more on the political landscape after me, so stay tuned for that. As we looked at the member survey we took about a year ago, we've identified trustworthiness, responsiveness, and reliability as the top attributes that you value in the Federal Home Loan Bank at Topeka. We will work hard to continue to have your confidence in those areas, especially our reliability. Reliability of being there for funds is, we know, very important for you, and we stand ready in all environments to be there to serve you and your funding and liquidity needs. We are currently in about a third of our workforce is working in the office, but as of Monday, the majority of those will roll back out, and that's because of changes in the local environment. We just had some announcements from our Shawnee County health director that recommending that if you can work from home, that you work from home. So we will be rolling back some of our in-house. So next slide. Jesse, sorry. We'll be rolling back some of that people that are currently at the office now, and we'll be back to maybe 20 of us here in the office or so but we look forward to, as it was when we went to work from home in March and April, be pretty seamless to you. One thing I do want to point out is Esther pointed the importance of community financial institutions to the economy. As Federal Home Loan Bank, we provide equity economic equity to rural and underserved areas. That's through our members, through our community financial institutions. We'd like to say we bring Wall Street to Main Street, but we provide funds, but it's only through you, only through our community financial institutions are we able to do that. We are a cooperative, and we are made up primarily of community financial institutions. So I view us as the model Federal Home Loan Bank. Now's the time to be thinking forward. You know, the regional account managers gave you some thoughts on some tools. We have a lot of tools out there to be used. If you're looking for things to do right now and ideas and opportunities, contact your regional account managers and they'll help you. Want to make sure that you're ready to accelerate into the recovery when it happens. About 2 years ago, we formed the member advisory group. Member advisory group is designed to provide feedback through our members to us. We are interested in your feedback. As you have feedback, provide them to your regional account managers, provide them to the lending desk when you call in. We also have the member experience survey, and we're going to take and build on that in the years to come here. So watch for more on our member experience initiative. Next slide, Jesse. Here you'll see a little bit about our financial situation. You know, some point in time assets, our total advances, capital, and also a little bit about profitability. Is the top line, you see net interest income. You see it declining. Well, it declined in relation to the decline in interest rates somewhat, as our invested capital is earning a little less, and we are shrinking in size some too. You see the total assets decreasing and advances decreasing as well, as we see our members have a lot more liquidity and a lot more deposits on their balance sheet. One of the risks we see is if there is a massive fiscal stimulus bill passed, the amount of liquidity that will flow back into the system. Targeted, if it's targeted, it won't be quite the same for us for community banks, but it just depends on what that fiscal stimulus looks like. We filed our 10Q for the third quarter on Tuesday of this week. If you are interested in looking at any more of our financial results, go out and to our website, and you'll find a link to our third quarter financials and our third quarter 10Q. So look there if you are interested in looking for more. You will see our capital stock stayed fairly constant there, and part of that was the MPF stock requirement that we implemented August to October during that time frame, where we implemented a 3% requirement on our MPF. That's to capitalize our growing MPF portfolio. You see our average dividend is decreased along with the decrease in interest rate. I added the average Fed funds for the quarters, but those were the average dividend rates. As we get to the quarter ended 9/30/2020, as our amount of Class B stock goes down, and primarily what you're seeing there in the decrease in stock from the end of the year till 9/30 is a decrease in our Class B stock or activity stock, as we sweep excess stock daily from Class B to Class A, as it's no longer needed. So that dividend of 5.25 for the third quarter on Class B and the 0.25 is biased a little more towards the lower 0.25%, 25 basis point rate paid on Class A. So next slide, Jesse. As one of our regional account managers mentioned, with the rollout of our letter of credit on an online service, you asked for in our member experience survey, you asked for ease of use for our products, and we're striving to deliver on those. We launched our online service on October 14th through members only. Since that time, we've already done 296 through our new line online. That's 39% of the volume. That doesn't mean that's 39% of our members that are using the online application, but 39% of the volume. We've had several members that are frequent users that have accounted for a number of those 296. Please take a look at this service. If you have questions, call the lending desk. They'll be happy to help you and walk you through it if you have questions or issues with it at all. We've heard a lot of good comments about it, and we're hoping that it will be a product that is the service that is very well used by our members. We think it will make it easy to transact those letters of credits with us. Mortgage partnership finance. Chris did mention a little bit that we've had some communication deficiencies this year as it relates to our MPF program. To admit that we've not done a good job of communicating the change in pricing that happened in late March, or the giving too much advance notice on the implementation of it should be the re-implementation of the activity stock requirement starting in August. We've received regulatory pressure to decrease MPF as a percentage of our total assets. In mid to late March, our pipeline of MPF loans were around $1 billion. As a result, we needed to slow down our growth in that product, so we at least flowing to our balance sheet, so we reduced our price. Recently, we've been working to move our members to MPF Extras, as Chris Endicott mentioned, but we're also working to improve our pricing on that. So we're looking for all other options to keep them from coming onto our balance sheet. And right now, as advances are declining, that makes our challenge a little even more difficult, because reducing it as a percentage of assets is much more difficult when your assets are falling. So, but don't forget the benefit of the new stock requirement, 5.25% dividend for last quarter. And as we said, I believe in our dividend announcement, we'll look for a similar dividend in the fourth quarter, although I can't promise that. Our next big project for letters for our online services is in the area of agreements. Hopefully this will automate the authorization and make it easier for you to manage your authorizations with the Federal Home Loan Bank of Topeka, especially for the online services that we're looking to go to in the future. We're the next one, it looks like we're talking about wire transfers. So I've got MPF right in front of me. So wire transfers, we're looking for that to be the next one after the agreement. So watch for more information on that. Next slide, Jesse. Some of you probably have seen it, but we've had a tiered pricing structure in place for over 20 years. We changed that and did away with that effective November 1st. We no longer have a tiered pricing. Everyone gets the same rate. And it says same low rate, and we emphasize the same low rate. We didn't move everybody up to the same rate. We moved everybody down to the lower rate. So everybody is getting the same rates as the larger advance sizes used to get. So take a look at that. Don't forget to factor in the dividend impact. We know that right now, with so much money looking for a home, that purchase deposits are really attractive. So if you have questions, call the lending desk or regional account managers to help you with the comparison of rates. Overnight line of credit, we're rolling that out on January 4th 2020, our current line of credit will go away. You don't have to do anything. It will roll over. It really won't go away. It's just the pricing will not be as attractive as it currently is. So everything will roll over to the new product on January 4th. As currently structured under our regulations for advanced pricing, it based upon the agreement, it's more of a 1-year term, and the pricing for that just wouldn't, if we priced it accordingly, would not be as favorable as the new overnight line of credit product will be. So watch for more of that, to be more information on that. We've seen quite a bit of growth in our letter of credit recently. We will be adding a stock requirement effective January 22nd will be the official notice of that. So I know we're sending out notices as we're going along. Jesse, next slide. One of the differences of being a member of the Federal Home Loan Bank versus getting your funding from other sources is our commitment to your success and helping your communities grow. We do that through our housing and community development programs, through affordable housing and homeowner set-aside program are the two there for their HCDs. But we've rolled out the 500 for Good last year, and we've had such a positive response last year and the number of applications this year that we doubled the amount that we're going to allocate for that program. So the applications are due next Wednesday. The application is as easy as, what good can I do can we do in our community with $500? So if you have questions, go out to our website. As you look at our HSP, you see that 150 members used it. Well, we've had good usage by Kansas and Nebraska members, but not Colorado. We understand Colorado with the housing prices, it's a little more challenging, but we've also not had good usage in Oklahoma. So I'm sure Trent will be out talking to you about the advantages of or at least talking to you over the web about how to utilize that and how easy it is and the benefits of that. So Oklahoma members, check into the HSP. Call your RAM if you call Trent if you have questions. Next slide, Jesse. Talk about our outlook moving forward. Federal Home Loan Banks are designed to expand and contract as you provide capital for us, or you have less capital required and we repurchase it periodically, or you request to redeem. But we are built to handle through the various economic cycles, when good times and bad times, and we've always been there for you, and we always look forward to being there in the future. We are currently seeing a decreased funding costs, and some of that's the decreasing rates, and some of that's the fact that we fund a lot of our balance sheet, at least part of our MPF, a majority of our MPF, with callable debt, and we've been able to refinance that and reissue it at much lower cost. So that helps us going forward, as we're seeing a lot of our MPF loans at the higher rates repay. Increased use of SOFR debt helps us to adjust to changing interest rate environments, like happened in March. We were funding a lot with discount notes, and 1 month to 3 months took us a while to reprice that debt. With using SOFR, that debt will reprice with the market almost instantaneously. So it will hopefully help us to be more market driven in our rates than we were during the March, April, May timeframe this year. MPF, we are looking at ways we are committed to MPF. We understand that it's an important product for a lot of our community financial institution members, and we can't hold everything on our balance sheet, so we are really exploring options for being able to place that volume and make it hopefully transparent to you. Bottom line right now, your Federal Home Loan Bank's performing well in spite of the challenging times. We will continue to be there as you need us, a reliable source of funding, quick and efficient. With that, I'll see if there are any questions. I know my time is I've used most of my time here, so.
Mark, let me check and see if there are any questions here for you. I think we have, I do not see any questions. Oh, wait, maybe there's one. There's one question related to where we are with e-signature, with the e-vault that our credit area is working on.
We're really close to, we will be rolling out shortly, at least through a few of our beta shops. We will be selecting some beta shops for testing the selected software for that. So we will be rolling it out. We are hopeful to be able to fully offer that sometime during early part of 2021. I wouldn't think that it will be too long, but if you have questions on it, we do have a lot of resources and information out on our website. Lance Libby is one of the ones that is leading it on behalf of the Federal Home Loan Bank system. So if you have questions, contact Lance. Lance is one who really got this rolling at the system level and made it a priority for us. Thanks, Lance, for all your work there.
Perfect. And I believe there's one more question. Let me we're having a little bit of trouble with me seeing all the questions, so bear with me just 1 second. I think there's a question about letters of credit, but I don't see it. Maybe one of my partners here can feed me the question over text. Okay, sorry about that. Have we seen any letter of credit applications for, I believe this means low income housing, LIHTC operating reserves? And
you can answer that better than I can, Susan.
Yeah, I don't,
you see all of them. I've not heard of any recently. So the majority of our letters of credit right now are for public unit deposits, which are fairly high right now.
Agreed. Yeah, 99% of what we get every day is just plain old city of, Auburn, Nebraska, or school districts, fire, states, political subdivisions. So yeah, I don't believe that we have. So one more question. I think we have time for one more question. And okay, it's related, Mark, to MPF pricing in March of 2020. So I think just elaborating a little bit on what you said, the question says, can you explain a little further what happened with pricing? The premiums on 30-year products have been weaker in the last few months.
Well, we were faced with a flood of MPF that was coming in onto our balance sheet, and with the pressure to reduce our footprint, if you will, or the percentage on our balance sheet, we had to either quit offering the product and stop it altogether, or decrease our price. We decreased our price, but where we fell down was not communicating clearly and not working as quickly as we should have to move people to the MPF Extra, where the pricing has been a little bit better. MPF Extra, of course, does not go to our balance sheet, so have been moving people there, and the simple. We were trying to reduce, we became a lot less competitive with other outlets. So, it was not a situation that we wanted to, but we are a product of our own success. Chris has been way too good selling it. We had too much flowing into our balance sheet, and our regulators simply said, we don't want that much on your balance sheet. So that was as simple as I can state it.
Thank you, Mark. Thank you. With that, I think that was our last question for you. Thanks so much for the update that you shared. I think we're all excited about all the new technology that's coming to make doing business with us a little easier for members. So thanks for all the information you shared on that as well.
All right. Thanks.
And thank you. And next we're going to hand it over to Ryan Gilliland. Ryan is our Government Relations Officer, and he is going to give us a little preview on what we might expect now that, can we call the election over yet? I'm not sure if we can call it over or not, but Ryan is going to give us some information on that. Thanks, Ryan.
Yeah, unfortunately not over. Good morning, everybody. I know it's a year where everything feels different, but in some ways it's exactly the same. On our Masters weekend here, I once again remain the last thing standing between all of you and some championship level golf, which has always defined the Federal Home Loan Bank regional meeting. So I will try to keep it as succinct as possible, but wanted to give you kind of a rundown of not only what we pay attention to, but kind of give you an idea of how we see things shaping up for you. And, first of all, I want to thank you for spending the time to do this. I know at this point in the year, a 2-hour Zoom meeting doesn't excite anybody, but the fact that we had such overwhelming response today to the meeting really is heartening to us. We spend a lot of time thinking about how we make you better, how we can serve you. And so to see that sort of reciprocated through your participation today means a lot to us. To set the stage a little bit, I want to give some context. If you go back 12 months to when we were going through these meetings, the things we were talking about in these discussions were very different. We were in the middle of sort of the tail end of a legislative fury that had seen us working on the possibility of expanded membership, GSE reform, some cannabis reform, and we all kind of anticipated that we'd finish out the year. We had been successful in holding off the membership expansion push by REITs and mortgage and hedge funds, and obviously, given everything that ended up happening, very fortunate now that we were able to prevail on that front last year. But then heading into this year, we assumed we'd have a little flurry of activity before everybody shut it down and headed to the campaign trail. And then the world stopped turning. So we immediately, I think like a lot of you, kind of rushed into triage mode and spent a lot of time working with obviously your state associations, but directly with our members, directly with our congressional offices to try to figure out how we could serve, how we could pitch in. We pretty quickly, actually warp speed for the Federal Home Loan Banks, came up with a package of about 5 legislative proposals that we thought might help. In the context of some of the stimulus packages that we're going through. It turned out to only be one stimulus package. And while we didn't end up in the middle of those, we didn't have any of that legislation advance, we also held off some charges that would have expanded us as well in that context. So it was a bit of a mixed bag. And I think like a lot of you in that triage moment, we sort of stuck our necks out and did a couple things that we would have naturally not been comfortable doing, but that's what needed to happen for us to serve our communities and to serve our members. So the same way that you do that every day, we were kind of aligned once again. And one of the things we've always quietly talked about, I guess, as a GSE, but certainly within the Federal Home Loan Bank system, is that we're designed to be there for the bad times. And, since 2008, we hadn't really had any sort of moment like that to sort of display that value to the broader financial system and to our members. So we, of course, never hope for things like that to happen. But I do think this year has served as another opportunity for us to sort of display that value and to display what we do for our members and why we're able to help our members in our ability to expand and contract immediately. And you don't often hear a regulator cheerleading for their regulated entity, but our regulator, Mark Calabria at the FHFA, has said in a few different forums this year that he was very pleased with the way the Federal Home Loan Banks as a system reacted in expanding and then quickly contracting and really operating in the way that you would hope they would operate. So we hope you have that same satisfaction. We hope you recognize that as well. And I think it will continue to be the case as we head into maybe another rough patch here over the fall and into next year, that we're going to stand at the ready, just like you do in your communities. So getting into the election, what are some of the takeaways? Obviously, sort of the first guttural reaction from a lot of folks, I think, has been, well, the Republicans held the Senate, so it's just going to be gridlock. Yeah. Yes and no. I think if the Democrats would have won the Senate and got to 54, 55 seats, it's a whole different beast. And I think they'd have made a run at DC statehood and Puerto Rico statehood and elimination of the filibuster and those types of things. And I can get into some of that later on why they were going to make that push, because there's just some structural reasons that it's very difficult for Democrats to take back the Senate at this point. And that was going to be kind of the last window of opportunity for them to do that because of the wins, some of the wins that they had actually in 2018 with Senator Tester and Senator Manchin. And so that this was a really important window for them to try to win those seats, or win enough seats to make some substantive changes that would even out their ability to compete in the Senate. But without that happening, there is obviously going to be a certain level of gridlock. But that doesn't mean there isn't going to be significant change and that there isn't going to be a real shift. We are, after all, still in the era of a pin and a phone, as President Obama so succinctly put it, and obviously seen the concept of increased executive and regulatory authority increase under President Trump. That's just going to continue. I think that's not just a feature anymore. That's a function of exactly how this is going to operate from here on out. So even though there is gridlock at the congressional level, the executive branch and the regulatory agencies have gotten very good at learning how to apply pressure to those regulators and to install the bureaucracy. And as you always hear, people are politics. And in this case, I think now that we've had a number of years where that's sort of become the norm, there is going to be significant change that comes simply from having executive branch change. So what's that change look like? Unlike the Trump administration in the early days, there was a lot of unexpected impact, and there was a lot of uncertainty about what that was going to look like. Been very different, of course, in this administration. Biden has really telegraphed a lot of the things that he wants to focus on. His economic platform is going to be focused squarely on the middle class. He has stated the following goals: closing the wealth gap, more support for CDFIs and minority depository institutions, focus on affordable housing and eviction foreclosure issues, which have obviously been exacerbated by the crisis, efforts to address the unbanked and expand the credit box, include racial inequality as a priority for banking policy. He's also proposed subjecting insurance companies and mortgage banks to CRA requirements, and an immediate focus on infrastructure. And that's one where I think we might have a role to play. We've spent a lot of time thinking about how we as a Federal Home Loan Bank can be more involved in these solutions and put a foot forward to say, look, we want to be a part of this, because if we don't, there's always the risk that you end up as a pay for, or you're just told to help out. So one thing we've really focused on is trying to say, look, think more about our architecture rather than our riches. And one way to think about that is that in the past, the use of letters of credit on tax exempt bonds, that was one of the 5 plan planks that we had produced earlier this year. We used to have that authority. We no longer have the authority to do that. So that's one issue that serves as kind of a good example when we're talking to Congress now to say, look, if there's an infrastructure package, that's something we can talk about. That's one way to think about using our architecture, which is truly the public-private partnership that people talk about, to maybe be involved. So we'll see how far those discussions go, but I do think infrastructure is going to be one of the first things they do. And I think you're going to see an aggressive, first 100 days agenda, and the Georgia race is going to impact a little bit of how far and how fast they can fly on that. But I think that's part of it. Moving over to the next sort of settled question, the House, and we kind of got a glimpse of it yesterday, actually. The House Financial Services Committee had a hearing, and the chairwoman there, Maxine Waters, gave you a glimpse of the playbook in her opening statement, which is pretty easy to find. But in her opening comments, she said something interesting. I thought it was she claims that voters have given Biden a mandate and highlighted a reverse in harmful policies that have deregulated Wall Street. She also highlighted Nebraska and said that the usury interest cap of 36% was an example of, the kind of progress that they intend to make. And I think you can see her trying to kind of expand the map by using that example. Commented that rules that would undermine the CRA and weaken the Volcker rule, which would allow banks to gamble with taxpayer money, are the kind of things they're going to focus on in her committee. Noted that her subcommittee on diversity and inclusion is going to continue its work and vowed that financial regulators will be much more diverse. Obviously brought up affordable housing and homelessness as a priority. And then intense oversight of large banks, prudential regulators, credit scoring, reporting, and cryptocurrency. So, and again, this was an oversight hearing or a hearing where they were going to work with regulators, or that they were going to start to hold regulators accountable. And so you can see again that dynamic that even if Congress doesn't have the ability to pass a bill, they have the ability to put pressure on these regulators and constantly bring them before the committee and say, hey, are we making progress on this? Where's this going? And they can force pressure on those agencies that of course are going to put pressure on us as well, or on members as well. So on the Senate side, it's still obviously up in the air. Your two choices are going to be Pat Toomey in terms of Senate Banking Committee Chairman Pat Toomey from Pennsylvania. And if Democrats were to split and hold it 50-50, you'd probably end up, and I say probably, end up with Sherrod Brown from Ohio. There is some precedent that in 2001, when there was a split, there was some deal making that went on and some jockeying to where certain committees would be split up a little bit differently, and there was more sharing of staff. So some of that remains to be seen, but I tend to think in the polarization or the polarized times that we're in right now, there's not going to be much of that. I think it's going to be one or the other. So with Toomey, you're going to have a far less expansive agenda. He's an investment banker, and you're going to be looking at the following priorities: capital markets, Chinese relations. He's open a discussion on fintech, payment systems, digital currency issues, Fed oversight. He's also made comments that the Fed's Main Street lending program and municipal lending program established by the CARES Act should concede at the end of the year. He's been blunt about that. With Brown, if you were to end up, and I think that's a very narrow likelihood that you end up with Brown, but you've got sort of an old school populist who's going to want to focus on low and middle income households. And as far as priorities, he's a little more succinct than Biden or Waters. It's pretty much housing. And that's always been a passion for him, but given the crisis, it's certainly in sharp focus now. He's going to focus on multifamily, the impact of eviction moratoria without corresponding funding for rental assistance. He's been beating that drum for a very long time, ever since the crisis began. And depending upon how this next wave goes, that might be a factor for sure, or it would certainly be a focus. And he was recently quoted. He said, the first thing we're going to do is major emergency rental assistance, and it's all going to be housing. So that was his quote when asked about what the priorities would be. So that's pretty distinct. I mean, you can tell where that's headed. But again, I think that's the more unlikely scenario. So that's sort of the 30,000 foot in terms of the environment. I hesitate to get into names on cabinet positions and who we'd be looking at the Treasury. I think Lil Brainerd is one of the names that obviously has come up, and you'd see a much more, or I guess a less averse view to the sort of globalist view of how we emerge from the crisis. And I think you'd see a totally different tenor there. But Janet Yellen's another name that's been mentioned, and it remains to be seen how that's going to play out. And I hesitate to get too far down the list on projecting where the names are at. But you can see some of these panels that Biden has released where he's got a list of 20 or 30 folks on different topic areas, and you can go look at their past and their history and pretty easily tell where a lot of this is headed, and it's consistent with the broad scale plans that they've already released and have publicized prior to the election. So in terms of the next few months, what we're looking at, next big hurdle is getting a spending bill. That's got to be done by December 12th. Hard to project, but given Trump's initial posture here, it's hard to see him wanting to cut many deals or be too helpful. Something will get done by the end of the year on the spending package. But I have been far less convinced we were going to get another stimulus bill really since the summer. You kept hearing that, we're going to get a second stimulus bill, and it was sort of a foregone conclusion. I've never felt that way, and I think there was even a talk. The last time I talked to some Senate staff a couple weeks ago about the idea of getting a stimulus package here before the end of the year, they were very optimistic as well, and this was prior to the election. But I just think the lines that both sides have drawn haven't really changed. And I don't know how A, Trump's posture, and B, the pressure that now is being applied as a result of the Georgia races is going to break that gridlock. So I think there's a possibility you could get a skinny bill, but even the idea of a skinny bill, I think a lot of people leap to the conclusion that that's a lot easier than it's going to be. So we shall see. That's a big one, obviously. Then in January, we'll get the results on the Georgia races, and we'll go from there. So regardless of all this, our message to you is simple. And as the Federal Home Loan Bank that truly represents community lending, we've got an obligation to tell the story, the most durable story, I think, in lending. And since I know I've got plenty of Nebraskans here with us today, you can appreciate that the best offense sometimes is a rock solid defense. And I think that we specifically in Topeka enjoy an identity through you and through our members that we can talk about how we sustain communities. We can show how community lending sustains communities. I'm the son of a banker. I've only been in this role for 5 years, but the reason I'm here is that I grew up watching how you build a community through a bank and how these banks in difficult times can sustain those communities. And so that's a durable message. That's a durable story. And I think that we have an obligation as a small state or a collection of small states that are shaped like squares to really tell that story and to put a face on a lot of these stories and be the tip of the spear on a lot of these things to help Congress understand, help regulators understand that we're the reason you do things like this. We're the reason you have a Federal Home Loan Bank that operates this way. And I think that message has gotten through, but as we continue to slog through tough times, I think it's more important than ever. So we want to stand next to you as your cooperative partner. So please let us know when we can help, and trust that we may call on you as well to help make that case as time unfolds. But that's sort of the 30,000 foot, and I'm happy to answer any questions. But again, I appreciate the time and appreciate you making the effort to be with us today, and look forward to the next few months and years ahead as we slog through things.
Thank you, Ryan. We do have one question, and it's related to the election and whether it's considered final yet, and is there a chance that it still could be reversed due to voter fraud, election fraud?
I think there's no chance. If you look at those margins, a lot of people read 538. I'm sure you may have heard of 538, and it's sort of this projection website. And it's called 538 because the separation in votes in Florida between Bush and Gore were 538. And there's this perception that we're kind of we're reliving that moment. But the reality is, if you go through and look at some of those vote margins, it's not that close. And I'm all for, I think personally, it's important to just play this out to the extent you can, because you can't have, for the good of our populace, half the country believing that elections are not valid. And that started in the last cycle and it's continued into this cycle. And I think that is a terrible, terrible precedent to set. So to a degree, you've got to let some of this play out. But I haven't seen any evidence. And until we see good, reliable evidence, I think it's really difficult to expect that you're going to flip that many votes. And it would take some really massive systemic changes or systemic issues and evidence thereof to flip some of these. And frankly, if you were going to do something like that, or if there was a massive effort to do some of this, you'd have probably got the Senate taken care of as well, right? And you'd have gone for Puerto Rico and DC statehood. And so I don't want to dive too deep into the weeds, but my perception and my professional opinion is it's over.
Thank you for that. I think that those are the only questions that we have, or maybe we have one more. Hold on just a second. I will check our chat here. I think that's it. I think that's all we have time for. So with that, thank you, Ryan, for that very timely update. It was interesting to hear the perspective on the election related directly to banking and what we can expect. Appreciate that.
Absolutely. Thanks, Susan.
Thank you. Next, we are going to do our prize drawing, and I see Susan Beam has joined us to do that. So we're going to draw 2 prize winners from the people that are still online. You do have to be present to win, so to speak, or virtually present to win. So I'll let Susan go ahead.
Hey, Jesse, do you have that slide to put up that shows what we're drawing for?
Yes, I do. Hold on.
Okay, here it is. So we are going to draw 2 names, and you will get to choose $250 worth of whatever of the month club you would like. And if I draw your name and you're still with us, I will give you a call and we can work through all the details on it. But as you see, you have 42 club choices there. You can see that on the screen. And as the title says, they are all amazing. And I have looked at them and I'm really hoping that someone will get like a huge chocolate package because I think that would be great. So I have downloaded all these names just a few minutes ago of people that were still online. So I hope you all stuck with us. And Leslie Mondesur, who is our member solutions manager, several months ago made this great spreadsheet for us where you can just shift F10 and it randomly chooses a name. So thank you, Leslie. We continue to use this in our virtual world. So here we go. I'm going to click over here. Okay. All right. Do we have Sabrina, is it Warner, W-A-N-E-R, with Allegiance Credit Union from Oklahoma City?
Wayner, I believe. Sabrina
Okay.
Wayner. Yep.
I'm going to just scroll down here. I don't think you guys can unmute yourself.
Let's see. I'll help you.
Okay. Oh, yep. She's still here. Okay.
Awesome.
So, Sabrina, you are our first winner, and I'll be giving you a call. Okay.
Congratulations.
Yes. Okay. Here we go. Okay. I have Andy Witt with Dundee Bank in Omaha, Nebraska. If Andy's still with us. Put back at the top. Oh, he is. He's still here. All right. So we have our 2 winners, Sabrina and Andy. And thank you, everybody, for sticking with us to the end. And we're really glad you could join us virtually. And I don't know if more than anyone, but I feel like more than anyone, I cannot wait to have live meetings again because it's my favorite.
Yeah.
All right, Susan.
Thank you, Susan. Appreciate it. Congratulations to the winners. Well, that wraps up our meeting for today. Thank you so much for joining us. We hope you enjoyed this little bit different format. I thought our speakers were great today, shared some good information, And I hope you did too, and that you take something away from this that you can use. And if you think of questions that you have after we conclude, feel free to reach out to any of us, especially it's a good place to start with the lending desk or your regional account manager. But you can certainly contact anybody at the bank and we will get you where you need to be to get your question answered. Once again, thank you for your participation and your attention.
Hi, Susan Seville. I just have a quick question, if you want to address it, or Susan B. Can you guys tell them who they need to contact for the CPE credit if there is any for this meeting?
Oh, so yeah, is there CPE credit? I'm sorry, I couldn't
Yes.
quite understand you.
Yes, there is. There's one CPE credit, and if you would just email your regional account manager, they will get that information to us.
Okay, perfect. Yep. So just drop a line to your account manager or give them a call and they'll be happy to get that information to the right spot so you get those credits. So, all right. Thank you again. And we look forward to hopefully seeing you in person at some time over the next few months. Thank you.